Hi everyone, thanks so much for joining us. First edition of what we're now terming our Econ Talks. We realise that in the office here at Infometrics we do a lot of discussions around what's happening in the economy, and we thought instead of just having those around our desks, we'd put them in front of a camera so that our clients and the public can get a bit of an insight into what we're talking about. My name's Brad Olsen, I'm a senior economist here at Infometrics, and I'm joined by our chief forecaster, Gareth Kiernan.
Yeah, thanks, Brad. So today we've had out a piece of data from RBNZ, the monthly economic indicators, and of course with the way the economy is going at the moment, keeping a sort of handle on how employment is going is pretty important. So Brad's been looking at those, he's going to give us a few of the highlights.
Yeah, it was really interesting there, Gareth, because what we've seen is that job numbers have bounced back. So during April we had nearly 37,000 jobs being lost. In May they have bounced back around about 17,000 additional jobs added over the month. That's in seasonally adjusted terms. What's probably more interesting is that while people are now employed, they're not being paid as much. We've seen that actually year on year, the total amount of earnings across the country fell $1.4 billion. Now that's because some people are on the wage subsidy, they're not getting as much money in their paychecks, either because they're being paid 80% of their previous wage, or at a bare minimum they're getting $585 a week for a full-time worker. At the same time, you've got some companies that are paying their staff less, they've implemented some sort of pay cut, as well as people that are working fewer hours, so they're still counted in a job, but the amount of take-home pay is lower. All of that suggesting that there's still quite a lot of tough period ahead for businesses, not as much money in households' back pockets. Those conditions out there in the economy remaining quite, I guess, uncertain in a sense, and we've seen, Gareth, as well, those big changes coming through from MSD. 30,000 workers over the last few weeks are being added to the wage subsidy. That's quite a big increase. Something like 200,000 are now on the subsidy extension. So again, it points towards those businesses in a very, very tough space.
Yeah, and obviously, look, today's employment number's only up to the end of May, so we've talked a lot over the last few weeks about a second wave of job losses. We had an initial wave with the lockdown and a number of people, of course, losing their jobs through that period. We're not too concerned or too perturbed about the job numbers today, because we think you'll need to wait until you really probably into July, really. You might see a little bit in June, but really through into July before you start to see more of those job losses coming through. We're just starting to see little inklings of that coming through in the job seeker numbers from MSD, but as Brad said, of course, still a lot of people on the wage subsidy as well, which is masking potentially just how bad those employment numbers are likely to become over the next few months.
And look, I mean, there is a lot of support, right? There's a lot of money being pumped into the economy at the moment by the Reserve Bank, and of course we had the official cash rate review last week. Obviously a bit of no real material change there, but a bit of wording changes that was coming through in the Reserve Bank statement. I mean, what did you make of that?
Yeah, I mean, no surprise there that they held where they were, but I think there was a clear signal that they were potentially considering further easing or further quantitative easing in coming months if conditions require that. What was interesting is we have the benefit of also having a bit of a chat to the Reserve Bank from time to time, and there was a video call that we had today. And what was interesting about that was that the bank has got their program of buying $60 billion of government bonds through until May next year, and even that deadline actually of May next year hadn't been that clear previously, but the bank has clarified that for us. Not a lot of idea at this moment from the Reserve Bank what might happen as we get up to May. At the moment they're just concentrating, basically they've said, on making sure that their weekly purchases are roughly in line, that by the time we get to that May deadline they will have used up that $60 billion envelope if they need to. But at this stage, after that, gosh, it's anyone's guess, which was a little surprising to me, because I mean, I understand the Reserve Bank, this is the first time we've had quantitative easing in New Zealand, but you go back to the GFC, 11 or 12 years ago, we did have quantitative easing in a number of countries around the world. You'd think there would be a reasonable template there for them to follow, but feel a little bit like they're flying blind at the moment.
And I mean, look, it's interesting because with something like this quantitative easing program, it is the new way that monetary policy is evolving at the moment. The official cash rate, of course, being left at 0.25% up until at least March next year, and so quantitative easing is that method that we're moving through. But of course, at the moment, that spending is only just keeping rates where they are. It's not driving them particularly lower at the moment. And so, of course, if the Reserve Bank does want to first keep those rates low, low and to possibly even drive them lower again, it is going to have to do something more. And I guess everyone in the market at the moment is trying to figure out how much could be spent over, in total and over what sort of time horizon.
Yeah, and one of the other interesting points to come out today was previously they'd suggested maybe they'd feel comfortable to purchasing up to around 60% of government bonds that were on offer. We looked at the numbers last week, and I think government debt in terms of the Treasury's projections is picked to go to around about 200 billion, which would have suggested they could have lifted their total purchases from 60 to about 120 billion. Today, actually, they pulled out a number of 50% as maybe being their cap, so suggests they don't have quite as much headroom there as we might have previously anticipated. Whatever the case, I'd suggest there is still scope, and possibly as soon as August, they may hold there, but given the Reserve Bank's views about how the economy may recover, they're among the more optimistic in terms of projections. There's not only Treasury would be more optimistic than the Reserve Bank's view. So I think there will be a push, or there will be a need for them to do further easing coming up.
And we've got a bit of a number in our heads, don't we, in terms of what that might be. I think we're expecting possibly another $30 billion to be added to that LSAP, the quantitative easing program over the next wee while.
Possibly, although with that shift to maybe $100 billion cap, they may look to move in 20 billion increments, or they may push it to 100 billion and be done with it, and then say, well, that's all we can do. We're going to have to turn to other instruments following that if we need to ease further. So yeah, it's a bit of fluidity there in terms of our thinking at the moment.
And look, what I found really interesting with that statement, Gareth, was that the tone was very, very carefully managed, because New Zealand has started to look like it was doing better, certainly compared to the world stage. A lot of other countries, of course, having quite a slower recovery path, or seeing, additional COVID-19 cases starting to come through. And I guess what that made me think of is that there is this balancing act moving forward, that the economic data at the moment is not quite as dire as we might have expected, and so if anything, that's bringing up that sort of starting point. But broadly, the conditions are still relatively soft, and there's so much support and so much disruption in the economy at the moment that getting a read on what's actually going on the ground is quite difficult. Again, the government pumping a lot of stimulus in, which is important, and it is keeping people in jobs, but we just can't continue to do that forever. And I guess moving forward, there is going to be that balancing act of how do we unwind that stimulus that we are providing to businesses, but also actually allowing the economy to structurally readjust, because it has to. We can't continue like this forever. And I think what we're starting to see now is, while the economic outlook might not be quite so dire in the near term, that extended period of lower growth, of lower economic activity, does seem to be sticking around.
Yeah, and the other point the Reserve Bank made around that as well is that while things might be feeling a little bit better in the near term, and we're all a little bit more optimistic maybe about just avoiding the worst of those economic outcomes, the upside risks are still pretty limited. The downside risks, if we go look at Victoria and Melbourne and the sort of wave of cases you're getting through there, if New Zealand did, God forbid, have to go into another round of lockdown, you can see the massive sort of downside economic risks there. So much more worried about those than the fact that we might be just going a little bit better in the near term.
Absolutely. Awesome. Thanks so much. Hope everyone's enjoyed it. It's been a bit of fun, and we'll continue to roll out our views as we continue to think about where the New Zealand economy is heading next.